Hi, this is Dora DeLellis with ThoughtsOnTheMoney.com. Welcome back to my vlog where I discuss money issues and offer practical money management tips. Today's flashback to 2008 follows the buyout of Bear Stearns, how their executives knew the financial risk of their activity, and how the subsequent fallout of the failure of the largest financial institutions was forming. CNBC just aired a special called Crisis on Wall Street on the frenzy of reactions during mid-September 2008 to deal with the quick domino effect of the bankruptcies of the country's largest banks. If you didn't watch it, you can probably catch a rerun. My first two articles are from June 2008. One article proves that the Bear Stearns executives knew that the subprime mortgage business was going to be a bloodbath. However, they delivered a level of comfort to investors. Regardless, at that point the damage was done and the job losses were expected to be pervasive. The third article reports on the job insecurity that ultimately lasted for years. Newly employed people now had to compete for jobs. I was in public accounting at the time, and I remember thinking that I was lucky to not be in industry, but little did I realize how far-reaching this would be. I lost my job in December of 2008 because of a quick reaction to the fear of falling revenue. I did get a corporate job a few months later, but employers basically exploited the job insecurity environment, and many people, including myself, only stayed at their first follow-up job for less than 1 year. So let's move on to some of the reasons for the financial collapse. We know what the big banks did, but here's where we can take some precautions. Personal responsibility number one is reckless borrowing, and that means that you do not understand the mortgage agreed to and you're not realistic about your ability to make the mortgage payment. I myself had an adjustable mortgage when I first bought my home in the mid-90s, but within a few years of my career, I kick-started my career such that I had several pay raises within the first few years of owning my home. Within 2 years of a solid payment history, I was able to refinance to a fixed mortgage. And because I had those pay increases, I knew that I would be able to meet the new mortgage payment. So my change in refinance was not because of the appreciation of the home. It was based on my credit history and built-in equity. Personal responsibility number two is blind faith on real estate appreciation. Your wealth should not be dependent upon the future appreciation of an asset. That's like buying a stock and betting the farm on believing that it will go up in value. That's basically taking a gamble. When the mortgage bankers were basically drunk with fast-moving mortgage products, they told buyers not to worry, that they could refinance when the property appreciated in value and have that additional cash in their pocket. That was the ignorance that buried many homeowners. Personal responsibility number three, buying the American dream. Just because someone tells you that you deserve the American dream of being a homeowner doesn't mean that it's for you if it's not a financial reality. It's great to have dreams and goals, but even I lived in a basement for 9 years until I was able to have the down payment and be eligible to support the mortgage. Be realistic. Just because someone's offering free money doesn't mean that you should latch on to the deal. On my next session, I'll show some visuals on the ensuing volatility of the stock markets. On last week's vlog session, I talked about being the CEO of your life and generating personal profits. I'd like to introduce how to take those personal profits and make that money work for you. While you can save money in a low-risk investment account, the best way to utilize those funds is to invest wisely. You're only one person and can only work one job. Okay, maybe two, but basically your time is limited. However, it's possible to leverage from the resources of many workers. When you invest that money into a business, you can earn a portion of the company's profits. That's the beauty of investing. And it works on two levels. You can earn dividends, and you can also benefit from the growth of the business. If you listen to Jim Cramer on Mad Money, he touts stock investing as the best way to accumulate wealth. There may be other ways, but for the average employee, I recommend it as well. I'll introduce some investing ideas in future vlog sessions, but I want to relate this discussion to a book that I read recently. The name of the book is called Fastlane Millionaire, and the author is M.J. DeMarco. He's a self-made millionaire and writes about becoming a small business owner and paving your own way. He basically denounces being a 9-to-5 employee and that you're trading your precious youth for a job that controls your time in life. He disdains the typical 40-year 401k advice that leaves you with being shorted of the best years of your life. It's a great motivational read for people willing to take the risk of an entrepreneurial venture, and he emphasizes the process and hard work that becoming self-made involves. However, I don't think it's for everybody. We need people to be employees. Things need to be built, services need to be performed, and products need to be sold. We need construction workers, police officers, and sanitation workers. And not everyone has the resources to become an entrepreneur. And even if they did, they may not have the success that the author had. Therefore, investing in businesses, i.e. stocks, is the most basic way to leverage your earnings into wealth accumulation. I want to save stock investing for another time because there's so much information out there on stocks. I want to talk about something a little bit more exciting, cryptocurrencies and blockchain technology. Crypto is often confused with blockchain or Bitcoin. Bitcoin is the largest virtual currency by market value, but if you hear the word blockchain, it is not synonymous. Blockchain is the technology that creates the virtual currency. According to the September issue of the Journal of Financial Planning, blockchain is the future and is soon to be life-changing. So don't say I didn't tell you so. The technology is moving into the fields of accounting, cancer research, insurance claims, and food safety. Due to its efficiency in recording transactions, it stands to disrupt many industries. There's a tremendous opportunity for wealth right now by buying into this when prices are low. I own Ripple and have it saved on my offline Ledger wallet that's locked in my fireproof box. I also own a little bit of Ethereum and Litecoin in a Coinbase account as well. Like Cramer says, your first $10,000 should be in plain vanilla index funds, then you can expand into other investments. Join me next week for more fun financial crisis memories, more causes of the economic collapse, and what could be the next financial crisis. Please leave feedback and questions on thoughtsonthemoney.com. Thanks, and I'll see you soon.